I don't know if you've been reading the news. The Bank of Canada is gearing up to shock the housing market once again. And this time, it's going to be the biggest shakeup yet, with inflation down to 1.6% and potentially falling even lower. The Bank of Canada is expected to cut rates by 50 basis points on October 23rd and possibly again in December. According to the news, this could be the moment buyers have been waiting for, opening up a rare opportunity in a challenging market across Canada. Hey guys, it's Cameron here. Today, we're going to break down why buying a home in 2024 feels almost impossible. We'll dive deep into the real estate challenges that you're all facing, everything from rising home prices to what's happening with the Bank of Canada and how that could dramatically impact your home buying journey. And stick around because I'm going to share some strategies you can use to get ahead of the competition despite how tough this market seems right now. And if you are looking to get into a more affordable market like New Brunswick, you can head down to the first link in the description and book a call with me, and we can explore some of those options. So, why does it feel like 2024 is the hardest time to buy a home in recent memory? It's the perfect storm of factors. Let's start with home prices. Across Canada, prices are at historic highs. In Toronto, the average home price is over $1 million, and Vancouver, it's even worse. Compare that to the 1990s when homes in these cities were just under $300,000. That's a price jump of nearly 400%. Now, if you're thinking, sure, prices were lower, but I know interest rates were higher, then you are right. Back in the 90s, your parents might have told you that they were paying as high as 15%. But here's the kicker. Even with those high rates, the actual percentage of their income going towards home ownership was a lot less. Today, in cities like Toronto and Vancouver, it takes upwards of 85% of your monthly income just to cover the mortgage. And across the country, 64%. Back in the 90s, it was around 45%. And according to Google right now, you should be allocating 30 to 33% of your gross monthly income towards housing. So, yes, while your parents had to deal with high rates, they weren't dealing with home prices that required most of their paycheck that went towards the mortgage. It's this deadly combination, astronomically high prices and interest rates, that's making home ownership feel out of reach for so many Canadians today. Even though today's rates aren't as high as those legendary 15% levels from the 90s, they're still making home ownership incredibly tough. Right now, mortgage rates are a fraction of what they were in the 90s, which might not seem too bad compared to that 15%, but remember, home prices have ballooned. In 2019, the average price in Canada was just over $500,000, and today it's over $700,000. The real kicker, the average Canadian now has to borrow more money than ever before just to afford a home. Even a 1% change in interest rates does mean hundreds of dollars in monthly payments. But here's where things get interesting and where the Bank of Canada's upcoming move could change everything. According to the headlines, on October 23rd, the Bank of Canada is expected to cut rates by 50 basis points, and it might not stop there. There's talk of another 50-point cut in December. This could be the biggest rate cut we've seen in years, and it's going to send shockwaves through the housing market, potentially. This potential rate cut could be a game changer for buyers. A rate cut could make borrowing cheaper and allow many people who have been sitting on the sidelines to finally jump into the market. Some recent news articles had conflicting details from economists scrambling to update their forecasts to predict what buyers might do if rates drop. Well, if mortgage rates drop, the difference in monthly payments could be substantial, if not hundreds of dollars a month less for their payments. But according to economists, there's a catch. When the rates drop, demand goes up, and more buyers could flood to the market and home prices could rise. But we didn't see that flood back in June, but this rate drop is predicting things to be different. I'm just not sure yet. In theory, if a prepared buyer who has been waiting for rates to drop can afford to borrow more, there's going to be more competition for the same or limited supply of homes that we have. And we have seen this before, but the market factors and forces were a little bit different. So while your mortgage payments might be a bit lower, you could end up paying more for the property itself. It is a double-edged sword. The lower interest rates do give you more buying power, but they can also push home prices higher as more people enter the market. So, if you have been eager to dive into the market, what can you do to make home ownership a reality either late this year or early next year? Might sound basic, but saving as much as possible for a down payment is crucial. The more you can put down, the less you'll have to borrow and the less impact higher rates could have on your monthly payment. If you can hit that 20% mark, you'll also avoid some of the extra costs for mortgage insurance. You'll also want to consider your mortgage product. I was on a call last week with a client that worked with a great broker, and they got them a flexible option that would allow them to lock in a rate if the rates change down in their favor. If cities like Toronto or Vancouver are out of reach, don't give up. There are smaller cities like Moncton or Halifax or even communities just outside of your major metro that could still be relatively affordable and prove to be a great long-term investment. Looping back to the 80s, my parents moved from their first home on the Queensway in Etobicoke to Burlington to get more for their dollar. And me, well, I did the exact same thing. I moved from Hamilton to Moncton and I got more for my dollar. There are many places across Canada that allow for affordable home ownership and great career opportunities. Do not overlook some of the programs that are available for first-time home buyers. Whether those are the savings account or the tax credits, those will help you achieve your goal. And they are designed to ease the financial burden of buying a home. So do your research and check them out. A pro tip, don't overlook homes that have been on the market for a while. If you are working with an experienced realtor, they can help you find those amazing deals and maybe even negotiate the purchase price lower than where they're at now. Now, looking further ahead, what happens after the Bank of Canada cuts rates? If the Bank of Canada cuts by 50 basis points in October and 50 in December, we could see mortgage rates dip into the 4% range for variable. Fixed rates might not fall as quickly, but they could end up somewhere around, high threes to fours in 2025. And this is where things get interesting. If rates fall and more buyers enter the market, we'll likely see an increase in home prices, particularly in the high demand areas in Canada. But it won't happen overnight. Prices might rise gradually through 2025 as the sales volume picks up. For now, the big takeaway is this: the market is shifting, and the upcoming rates could create an opportunity for those that are ready to act. While a 50 basis point cut might seem like a win for buyers, it could indicate a weakening economy. When rates drop aggressively, it's often a response to slowing economic growth, meaning job losses could follow, especially in sensitive sectors. Deflation is also another risk. When prices drop consistently over time, people might delay major purchases and they could expect that prices will fall further. This does reduce demand, which could lead to more job loss or economic slowdown. In the housing market, this could lead to lower prices, but fewer buyers might not feel confident enough to take advantage of the opportunity. If the economy starts to slow, the government does have several options to prevent further damage. And in no particular order, it could be job creation or tax cuts or stimulus packages, or even greater first-time homebuyer incentives. While we can't predict every move, it's important to be aware of the broader economic picture. Job losses, deflation, government intervention all impact the housing market. As a buyer, focus on your financial health, build your emergency fund, reduce your debt, and stay prepared. The more secure you are, the better you'll navigate the shifting market. If you found this video helpful, make sure to hit that like button and subscribe for more information on the Canadian housing market. In the comments down below, let me know, are you waiting for rates to drop before jumping into the market, or are you already on the hunt for your next home? I'd love to hear your thoughts. The Canadian housing market in 2024 is complex. High prices, interest rates, economic uncertainty, it all plays a role. While rate cuts may offer opportunities, be mindful of the big picture. With the right strategy, including maximizing your savings, exploring alternative markets, leveraging government programs, you can still succeed. Thanks for watching, and until next time.